it was striking to me that in the war's inflation scare, which was a global event where it looked like oil prices were going to go bananas, there was going to be second order effects on prices all over the world. We actually started to see that in some places. Yields everywhere went up. Government bond yields everywhere went up, meaning government bonds prices went down. But it was the UK that turned out to be the most sensitive. In other words, yields on the 10-year gilt moved up faster than those of other big developed countries, especially those in Europe. How do we explain that sensitivity?
That's partly because the UK came into this conflict with inflation running higher than elsewhere. It was about 3% in the UK, so it was higher than it was in the euro area. So that burst in inflation from the war fueled inflation that was already starting at a higher base. It also meant that there was a particularly sharp movement in interest rate expectations in the UK, where people coming into the conflict thought there might be a couple of quarter point cuts to the Bank of England interest rate. And quite short order, they moved to expecting increases to the interest rate. So there was quite a sharp shift in that because of the rising inflation expectations. That's partly because we have a lot of gas boilers. I have one. And other reasons why we were sensitive to an energy shock coming from the Middle East.